Over the past few weeks, something important has changed in the Middle East, and markets still haven't fully absorbed it. The US isn't talking about maximum pressure anymore. It's moved into a new phase, maximum enforcement. This isn't about speeches, sanctions lists, or dramatic airstrikes. It's about ships, insurance, choke points, and control of the sea lanes that keep the global economy moving. Today I want to walk you through what's happening, why Washington is shifting strategy, and why this could define energy markets and Gulf stability for the rest of 2026. For most of the past decade, US pressure on Iran relied on financial sanctions, cutting access to banks, insurers, and dollar clearing. That model worked, until it didn't. Over time, Iran adapted. It built alternative payment channels, it relied on China, it created a shadow logistics system that functioned outside formal markets. By 2024 to 2025, sanctions were no longer stopping exports, they were merely discounting them. What we are seeing now is a shift from economic friction to physical disruption. Instead of asking banks not to process payments, the US is increasingly willing to stop tankers, seize cargo, or make voyages so risky that shipping becomes uneconomic. The deployment of the USS Abraham Lincoln isn't symbolic. It gives Washington the ability to enforce this model across a much larger theater. So, why this is called horizontal escalation? This strategy avoids the most dangerous forms of escalation. Rather than striking oil fields, refineries, or ports on Iranian soil, the US escalates horizontally, targeting the logistics ecosystem around Iran. That matters for three reasons. It limits immediate retaliation. Iran can't easily justify a full military response if no onshore targets are hit. It preserves deniability. Seizures can be framed as legal enforcement, not acts of war. It hits the regime where it's weakest. Iran's export system depends on fragile, aging, legally exposed shipping. This is pressure without a trigger pull moment, and that's exactly why it's attractive. So what changed Washington's mind? Earlier this year, the US quietly demonstrated that interdiction works. In the Caribbean, US forces seized or disrupted tankers linked to sanctioned flows. Those barrels didn't reroute, they vanished. From Washington's perspective, this was a breakthrough. Immediate supply impact, no airstrikes, no UN resolutions, no congressional authorization required. That success is what's now being replicated, cautiously, in the Persian Gulf. The dark fleet problem. Why does 1 million barrels per day matters? Iran exports between 1.2 and 1.5 million barrels per day through what's known as the dark fleet. These vessels are old, underinsured, often owned by shell companies, and increasingly difficult to maintain. Remove 1 million barrels per day, and three things happen. 1. Iran's budget breaks faster than sanctions ever achieved. 2. China faces supply chains that are operationally risky. 3. Shadow shipping economics collapse under insurance pressure. This isn't about removing all exports. It's about removing the marginal barrel that keeps the system viable. Iran's response: blocking the Strait of Hormuz isn't the first move. Iran has one overriding constraint: it must keep exporting oil. That's why a full closure of the Strait of Hormuz is unlikely. It would choke Iran's own revenue before it hurts the West. Instead, Iran's retaliation toolbox is subtler: harassment of Western-linked tankers, drone flyovers and near misses, cyber attacks on port logistics, hull damage that spikes insurance costs. The objective isn't escalation, it's uncertainty. Historically, Iran responds within 48 to 72 hours of enforcement actions. That pattern is likely to repeat. Why this changes oil market psychology? This is where markets often get it wrong. The risk premium today isn't about a single strike, a single headline, or a single supply outage. It's about duration. Brent already carries a $3 to $5 structural premium, and unlike past spikes, it doesn't fade quickly. Options markets are telling the same story. More long-dated upside calls, less confidence in mean reversion, greater pricing of tail risk. If Hormuz becomes intermittently unreliable, oil doesn't need to stop flowing to reach $90 to $100. It just needs to arrive late, insured expensively, and unpredictably. There's also a refining issue that gets overlooked. Iranian and Venezuelan crude are heavy grades. Many Asian refiners, especially in India and China, are configured specifically for them. US shale isn't a perfect substitute. So a simultaneous squeeze on both Iranian and Venezuelan exports creates refinery mismatches, margin compression, and higher product prices downstream. This is a supply quality problem, not just a volume problem. For Gulf producers, the biggest risk isn't losing oil output. It's losing competitiveness. If war risk insurance rises to 2.5 to 3.5% of cargo value, Gulf exports become more expensive than West Africa, Brazil, Guyana. This then directly undermines Saudi Arabia's Vision 2030, tourism inflows, foreign direct investment. This is why Gulf capitals are prioritizing de-escalation, even while preparing defensively. Stability, not alignment, is the real currency. So what will happen? This isn't a crisis moment. It's a new operating environment. A world where maritime friction is persistent, energy flows are politicized, and volatility is structural. For traders, governments, and investors, the message is simple. Prepare for friction, not collapse. Price risk, not headlines. The era of cheap geopolitics is over, and the sea lanes are where the next phase is being decided.